While the Canadian economy emerged bruised but not beaten during the Great Recession, weakened export demand in recent quarters has seen growth lag. Joining us now to detail what the Canadian economy can look forward to in the year 2014. Avery Schenfeld, he's chief economist with CIBC World Markets. Aaron Weir, economist with the United Steelworkers Union. And Don Breen, professor of finance and business economics at the U of T's Rotman School of Management. I hope it's still not too late to say Happy New Year to everybody. First time I've seen all of you in the new year. Let's just bring this graph up if we can to start our discussion here so we can see what the Canadian Business Outlook Survey for the year looks like. While not yet reporting a material pickup in past sales activity, businesses are hopeful that they will see an improvement over the next 12 months. Assessments of business activity vary across regions and sectors, however. Some firms have seen encouraging signs, while others remain uncertain about the timing of any notable improvement. Let's start there. Avery, to you first. What is your overall impression of the strength of the Canadian economy as we sit here today in the first month of the new year?
Well, those survey results sounded like a pretty wishy-washy overall conclusion.
They did.
And I think that's consistent with what we expect to see. So last year was actually quite a slow year for the Canadian economy. And what businesses are telling us is they think that 2014 will be better than that year. So it's a low bar to jump over. They think they'll jump over it. I think they're right. But we're still looking at a mediocre year for economic growth. To put it in perspective, the kind of growth rate that won't really pull the unemployment rate down dramatically, maybe edge it down a little bit from where it is now.
So 1, 2?
So probably starting with a 2. And we can debate the decimal places, but we really need to see growth of 0.5% higher than that. We'd like to see something closer to 3% growth, which is where we actually think the U.S. economy will be. So the U.S. has been playing catch up to us. We had that milder recession, and I think they're still going to be leaving us a bit in the dust in 2014.
Don Breen, what are you seeing?
Well, certainly the optimism index has ramped up a little bit. What's going to happen with the Canadian economy, I feel, is that the basis of growth is going to change. For the past number of years, our growth has come from domestic spending and government spending, and not nearly so much as we would like in investment and exports. But I do think with the precipitous fall of the Canadian dollar, which is a good thing, and the signals that the U.S. is going to be stronger, both of those things will shift the composition of the growth factors in our economy.
More on the strength of the Canadian dollar to come in our discussion. Aaron Weir, what are you seeing?
Well, the aspect of the economy that matters most to most people is the job market. And 2013 was really an unimpressive year in terms of employment growth. Canadian employers created an average of 8,500 jobs per month, while Canada's working age population grows by more than 30,000 per month. The numbers in Ontario were even worse. Employers created an average of only 2,000 jobs per month, while the province's working age population grew by more than 10,000 per month.
So we're constantly falling behind.
That's right, and we need a significant improvement just to get to the point where we're treading water. And frankly, I share Avery's concern that we won't see enough economic growth to meaningfully reduce unemployment.
We'll talk about some strategies for doing that as well. Don, how difficult is it forecasting economic strength or weakness today versus, say, 10 or 20 years ago?
It's quite a bit different.
How come?
Economists are quite skilled, or have been quite skilled, at predicting things that are cyclical. Movements down in the business cycle, bottoming out, rising in the business cycle, topping out. But we've had some significant structural changes in the economy of the country and also in the international setting that we operate within. And these structural changes make it much more difficult to be an accurate economic forecaster. Look at how much we missed our forecast of exports last week when the numbers came out. That then led the governor of the bank to say, we've got to rejig our export modeling practices. So we might get into some of the major structural changes that are taking place, but to give you a hint at that, look, you've got the rise of China. That has a global influence that affects all manufacturing. You've got the U.S. suddenly in a situation where it's going to be a powerful producer of energy and not so much an importer of energy. That's going to affect Canada. These structural changes are important, and they make the task of forecasting the economy all that more difficult.
Speaking of the U.S., how sure are you that what we're seeing south of the border right now is the real deal in terms of economic recovery?
Well, I think it is. as economists, you're always better explaining what's already happened than forecasting what's going to happen. But if you go back, actually, the U.S. had a pretty good year in 2012, grew at 2.8%. People sometimes forget that that was actually a good year. 2013 was then a slower year in between, particularly the first half. And I chalk a lot of that up to the fact that we had a tax hike on average households worth about $1,000 a year. That put a bit of a dent into household spending. We had some still pretty big layoffs at the government side going into the year. And that cast a lead weight on the economy. What we now know in terms of fiscal policy is there's no big tax hike coming on the household sector this year. The government spending cuts, there still are some restraint at the federal level, but state and local governments may be starting to hire again. And without that lead weight, we think that the fundamentals are in place to go back to the kind of growth rate we had in 2012, maybe a bit better. So the big downside risks were risks of another fiscal battleground that led to either big tax hikes or government shutdowns. That's behind us. And I think that with a lot of pent-up demand, remember, Americans haven't been buying houses, haven't been consuming aggressively for the past few years. They're getting the kind of job growth, at least on a trend basis, that gives them some room to spend again.
Yours is a union that represents workers on both sides of the border.
That's right.
From what you hear from your American colleagues, does it feel real down there?
Well, I think that the United States has been through a really awful housing bust and credit crunch. As a result of that, the United States appears to be poised for a housing recovery. American consumers have reduced their debt and therefore are positioned to start spending again. So those are good signs. I think the reason that Canada outperformed the United States is that we didn't really have a housing bust or a credit crunch. Our real estate market kept going up. Our consumers kept spending. As a result of that, though, we now have real estate prices that are overvalued by many measures, and we also have household debt at record highs. So the possibility of a slowdown in our housing market or consumers not spending as much remain risks to Canadian economic growth.
Unsafe risks?
I think so. I mean, I think risks are by definition unsafe.
Well, there's good risks and bad risks, but it sounds like you're saying this is not a
good... risks to the downside, absolutely. Things that could really crimp Canadian economic growth. And I think that's part of the reason that we're now in this situation of talking about riding the American coattails in 2014.
Don, the Federal Reserve in the United States appears now poised to stop priming the pump as much as they once did. In order to encourage economic activity and growth and so on. Good idea, bad idea? What do you think?
Oh, it's an inevitability, and it's a question of not if, but when, and it does seem to, we are seeing signs that tapering has begun.
What do you think of the timing of that decision?
I think it's appropriate. You know, we have been in a period for about 4 to 5 years now of what's known as unconventional monetary policy, where central banks in the United States, United Kingdom, and Japan, but not so much in Canada, have been very, very aggressive in their stimulation via monetary policy. And that has to come to a point.
Explain what that is. Stimulation via monetary policy refers to
basically the Federal Reserve in the United States, the Bank of England there, and the Bank of Japan have been buying government securities, doing everything they can to keep interest rates lower at the longer end. And interest rates have been driven to historically low levels in order to get the economy moving so that anything that's interest sensitive, such as construction or investment, would be given something of a boost. But there's only so long you can remain unconventional. There's a point at which interest rates are going to have to be allowed to rise to more natural levels, nothing that's bouncing around zero. Do I think the timing is right to start that? I do believe it is. And that's going to have an effect on the US dollar, strengthening the US dollar, and relatively weakening the Canadian dollar further.
What do you think about the timing of that?
Well, I would actually like to see more tangible evidence of an American recovery before the Federal Reserve starts to taper. I do think part of the reason it's happening a bit prematurely is that there's tremendous political pressure from the Republican base, which really doesn't seem to believe in central banking and certainly is very skeptical of quantitative easing. So I think they're tapering a bit too soon. The challenge the Fed has is to basically tell markets that while they're going to slow down the bond purchases, they simultaneously will keep short-term interest rates very low. And I do think that in announcing the tapering this past month, the Federal Reserve actually struck that balance pretty well. I think the risk would have been that any talk of tapering would have sent a signal to markets that the Federal Reserve was really going to tighten up monetary policy across the board, but they seem to have avoided that pitfall. So I think they're doing it too soon, but their execution has been pretty deft.
Okay. Don referred a few minutes ago to the fact that the dollar is now at a level vis-a-vis its American counterpart that he prefers. Mm-hmm. We all remember the dollar once upon a time, not that long ago, was trading at a higher rate than the American dollar. It's now, I guess, closer to 90 cents than closer to par. Avery, are you happier with a dollar that's closer to 90 cents than closer to par?
I'm happier. I'm not one of the people who benefit from that, but I am happier.
Why?
In the sense that I think our dollar was actually trading at an artificially elevated level. Artificial in the sense that what had propped it up in the last 2 years was actually some other central banks meddling in our exchange rate. So remember that while the governor of the Bank of Canada, the previous one, the current one, have not intervened in the exchange markets, foreign central banks around the world were intervening. They were buying piles of Canadian dollar bonds. They liked the safety. They liked the AAA rating. And for a while, that was holding the Canadian dollar up 10 or 15 cents stronger than at least our trade conditions would otherwise have dictated.
Because it gave the world the indication that our currency was actually more dear than it actually was?
Well, in buying it, they bid up its value. They were selling some of their U.S. dollar holdings, worried about where the U.S. was going. They were really also in a diversification phase where they were moving a little bit of the money that they had in dollars and euros and putting it into other currencies. And ours was one of the prominent others that they bought. The result was that on the trade side, we were running quite a large deficit with the rest of the world. We were importing a lot more than we were exporting. And normally, without that intervention, the currency would have weakened earlier and made that adjustment. So I think what we're seeing now is actually a return to a free market exchange rate, which we really didn't have before. We had an artificially propped up exchange rate. We're getting a return to somewhere near where the currency might otherwise have been. And maybe it's a little bit too little too late, but it will help some of our exporters do better. I'd agree with Aaron that we're entering a period where we can't just keep growing by building each other condos. At some point you have to actually be exporting something to the rest of the world. We're going to have enough condos. And so getting the exchange rate down to a level that's a bit more competitive in terms of what we pay our workers now in US dollar terms will help the economy transition to that export-led growth.
If, however, Don, you're a business that needs to buy equipment or machinery from an American supplier, it now costs you 10% more.
Indeed, and I worry a little bit that the opportunity to buy imported capital goods when we had a high-valued Canadian dollar, I wonder whether that opportunity was exploited as much as it could have, but now the opportunity has faded.
And yet you're happy, though, that it's at 90 rather than 100.
But you can be reasonably of two minds on these things. When the Canadian dollar is strong, the cold winds of international competition are forcing firms to be more innovative, to be more efficient, to be more productive. Again, those cold winds were not blowing at a time when Canada was growing strongly, so we didn't capture those benefits as much as we'd like. But now I think it's very important, in line with points that Aaron has made, to do things via the exchange rate that will give a boost to our exports, to shift that composition of our growth. I would like to say, though, this is not a managed process in Canada. While Steve Pelose and Jim Flaherty might be applauding the movement.
Just people know who Jim Flaherty is. They may not know Stephen Pelose.
Stephen Pelose is the
governor of the bank.
The governor of the Bank of Canada. Yeah. While I suspect they are pleased with this development, I do not believe that they have actually initiated it. The Bank of Canada, as Avery said, is not in the business of managing the exchange rate directly, and Minister Flaherty wouldn't have to. But as a policy position, if it ever had been sort of orchestrated, that would have been the way you would do it. But
I always had a problem, by the way, with the theory that a strong Canadian dollar would prompt businesses to import all this equipment and put it into their businesses here. Because there is a counter to that. If I'm a Canadian, say, auto parts manufacturer, yes, I can take my Canadian dollars and buy machinery and production lines more cheaply, but I could also then choose to install them in the southern US or Mexico, where labor becomes cheaper when their currencies are cheaper. So I think part of the problem is if you actually look at what Canadian businesses did, some of them, yes, they did make capital expansions, but they didn't necessarily do it at home. So we certainly need to be at a competitive exchange rate, one that drives demand for our products in order to get businesses to invest. Just telling them you can buy the equipment cheaply doesn't necessarily tell them, and you should put that equipment into Canada.
In which case, Aaron, would you prefer, certainly for steelworkers, an 80-cent dollar as opposed to a 90-cent dollar?
Well, all three of us wore red ties today, and it seems like we're all pretty happy to see the Canadian dollar in the red. Certainly, I would welcome a more moderate exchange rate. Purchasing power parity would suggest that a Canadian dollar actually only buys about as much as Canada as 82 cents would buy in the United States. So that would be a fundamental benchmark that should indeed suggest the exchange rate could moderate even further, and certainly that would be a great thing for Canadian-based exporters.
Unless, of course, you want to go to Disney World, and then you're spending 20% more than you otherwise would.
Yeah, no, that's absolutely a trade-off, but I would actually suggest that keeping more of those Canadian consumer dollars in Canada might be a good thing.
Yeah, it is January, though.
Well,
people do want to go to sunnier places.
Well, they could go to Vancouver, I guess. It's more temperate on the West Coast.
Okay, fair enough. How long, well, let me follow up with you. How long would you expect we'd have to wait to see before we get tangible evidence that a 90-cent dollar is actually having the impact on our manufacturing base that you would want to see?
Well, first of all, we have to see how long it stays around 90 cents.
Good point.
I think everyone on the panel sees this depreciation as appropriate, and so we're probably inclined to believe that it's here to stay. But I think psychologically, a lot of Canadians got used to the idea that it's at parity and may expect it to go back up there. I think you might see some small changes benefiting exporters, but to see investment decisions actually being made on the basis of our exchange rate being competitive will take some time. I think we're talking about years rather than months.
Okay, let's put the focus now. We've sort of looked macro, let's come home. The province of Ontario doesn't make monetary policy. It can't mess around with exchange rates or anything like that. It has to live by them. So as you look, Avery, for the year ahead in the province of Ontario, and I guess we'll have having a federal budget next month that will have an impact on Ontario, and then a provincial budget shortly thereafter, which may beget an election, who knows. What are you seeing in this province as an economic outlook?
Well, I'm not seeing the kind of things that would want me to be in the chair of the finance minister and actually have to deliver that budget. We will probably grow a little bit slower than the national average because
is that a 1 or a 2?
Well, I think it'll be a 2, but it'll be a decimal place or 2 below the national average. It might be about 2% growth, which is, it's okay. And the problem is, of course, the province is still wrestling with a pretty big debt that it ran up during weak economic times when it tried to stimulate appropriately. It's trying to winnow that down. And 2% economic growth does not give you a lot of revenue coming in your pocket that gives you room to really do a lot. So this is an environment in which the province has to, I think, be nimble in terms of trying to attract investment. It's been talking to Ford and Chrysler and so on, trying to make sure that it's competitive with offers being dangled in front of those car companies, for example, in the US South. I think that's appropriate. It's trying to maintain, certainly not raise taxes to slow the growth further. But it doesn't have a lot of elbow room. I suspect that the budget, for example, is going to be, a pretty short budget in the sense of not a lot of items, because they don't have a lot of obvious initiatives that they can afford right now to drive growth.
Having said that, Don, I can recall former Liberal Finance Minister Greg Sorbera saying, people like you always underestimate the ability of the Ontario economy to perform and deliver more revenue to the Treasury than the officials, for example, in his ministry expected to happen. Is that true?
There's a lot to that. I think as far as Ontario is concerned, I'm probably a little less pessimistic about Ontario's position vis-a-vis the rest of the country as a result of the changes that have been taking place. I think the depreciation of the Canadian dollar, the recent depreciation of the Canadian dollar, the prospects for economic growth in the United States play more into Ontario than to the rest of the country because of the importance of our auto sector, for example. And we do have about 45% of all the manufacturing in the country. And I think once the wheels start turning in the sectors that are sensitive to U.S. growth and a lower Canadian dollar, I think that will play into to Ontario's hands relative to, say, Alberta, where energy prospects, those energy commodities have been in the doldrums of late, and that again is an American story because of the expansion of energy production in the United States. So it's not a horse race. It shouldn't be presented that way anyway, but I do think that some of the fundamentals are shifting in favor of Ontario, and so I wouldn't necessarily put the projection of Ontario's performance a decimal point below the national average. I'd put it a decimal point above.
A decimal point above. Mm-hmm. So you two are disagreeing to the extent of 0.2%.
The one thing I'd say about Ontario is that we've also had the brunt of the condo boom. And as we start to sell fewer of them, which is happening now, we will be building fewer of them. So Ontario's challenge is actually to replace a lot of growth that we got in sectors like construction with growth in something else. If you look at the last year, it's interesting, the US auto sales have surged. North American auto sales, in fact, have done fantastically. If you actually look at what has happened to auto assemblies in Canada, they're down year over year. Remember all those plant closure announcements a couple of years ago? Well, the plants have been closing. And so the plants that are remaining, yes, they're producing more, but once you take away the ones that are closing, actually, it's been very disappointing. So we will get some leverage in Ontario from a better US economy, but in terms of the normal linkage, that linkage, it's not broken, but it's not nearly as powerful as it had been.
Okay, I want to spend our remaining 5 or 6 minutes here talking about an announcement of significance that Tim Hudak, the Ontario Conservative leader, made earlier this week, in which he came out with a 5-point plan saying, if you elect me and if I can do these things, this province is going to get 1 million private sector jobs over the next 8 years. And briefly, reduce debt and taxes, encouraging more young people to train for skilled trades, increase trade with other provinces through new interprovincial free trade agreements, make better use of federal immigration programs, matching immigrants to jobs, reduce regulatory red tape by 1/3 over 3 years. Here's a question. How realistic is it in this day and age, Aaron first, for any politician to put forward a platform in which he says, do this and we'll create 1 million jobs?
Well, if Tim Hudak were here, I'm sure he'd hasten to point out that Ontario employment did increase by 1 million during the 8 years of Mike Harris and Ernie Eves. I guess the real question, though, is why did that happen? I think it happened largely because you had a red-hot American economy as well as a Canadian dollar fall into 62 US cents. So it was a good time to be a branch plant of the United States. I do think, though, it's almost ridiculous to suggest that any given set of policies could be relied upon to create 1 million jobs. And it reminds me a little bit of what the American governor of Wisconsin, Scott Walker, did. He promised to create 250,000 jobs in 4 years, and actually has not even created half that many. Wisconsin actually lags other American states in terms of job creation. So I really do see this as a page taken out of the U.S. Republican playbook. And I mean, for what it's worth, I actually think the policies Hudak is proposing would reduce employment.
Don.
I'll take 2 points from the Hudak agenda. First, with respect to the corporate tax and the impact of a point reduction in that to attract new investment. I don't think that that's what would really drive investment. I would think economic expansion generally would be what would drive investment. The one point that I really like about Hudak's proposal is his emphasis on training. Because the more flexible is your labor force when the structure of your economy is changing, the more your labor force can play into the growth prospects that are there. And so I like that, and there were some suggestions too of encouraging innovation by enhancing flexibility within industry and removing barriers between provinces. Now that tends to be a national debate as opposed to a provincial debate, and if any Ontario premier, whether it's with the Liberals or the PCs, was to drive that agenda, I think that would be a smart thing to do. So he's hinting at it, and I think it's wise.
Promising 1 million jobs over 8 years?
Well, 8-year forecasts are meant to be broken one way or the other. We don't even forecast beyond 2 years in our own shop, so I think it is always difficult to project out that far. I think that some of these are pretty uncontroversial, actually. I would say, for example, that we don't do the best job matching the education system with the demands of the labor market. We somehow have an Ontario government, for example, that runs the education system by and large, graduates more teachers than the education system that hires teachers actually needs. So we don't actually do a good job making the size of those programs match the demand, even when government is involved on both the education and the hiring. And I think the same thing is somewhat true with immigration, although there's a lot of federal responsibility there. We've improved a bit, but I think there's more to do to matching the immigrants, bringing the right kinds of immigrants in. Whether a corporate income tax cut will be valuable, I mean, any economic model will show you that a corporate income tax cut will help growth. The one caveat is that if you're aiming at a specific budget deficit target, if you cut someone's taxes, whose are you raising and how much do you lose? So, or whose paycheck are you reducing by cutting government spending by the equivalent amount? So I haven't seen the math. Obviously, the Conservatives will release more details on this, and economists and voters will be in a position to analyze it better when we see all of it.
We should also remember that Ontario did just cut its corporate tax rate from 14 to 11.5%, and while that certainly has boosted after-tax corporate profits, there's very little evidence that it's actually improved investment or employment. I mean, we're just talking about how companies failed to take advantage of the high exchange rate to buy more machinery and equipment. Well, the other thing they failed to take advantage of was all these additional after-tax profits. They didn't use them to buy machinery and equipment either. So I'm very much unconvinced that further across the board corporate tax cuts are the solution. What I would like to see is much more targeted incentives where we say we'll give companies an investment tax credit if they actually make investments in Ontario or in Canada. Either companies would invest and make use of those incentives, or the government would be able to collect more revenue by reversing the corporate tax rate reductions and invest more money in public infrastructure.
Don, that's a pretty uncontroversial thing, what he just said.
Yes.
We've heard the federal Conservative finance minister, the provincial Liberal finance minister, the former governor of the Bank of Canada all say, we gave you corporations tax cuts, you pocketed the money, and you're sitting on lots of dead money now, so-called. So he's not wrong when he says corporate tax cuts have not begat the jobs they promised they'd create.
Around the panel, it's 2-to-1 on that position. I see that, that corporate tax cuts are not an immediate guarantee of promoted investment. More targeted use of the fiscal system, the tax system for the corporations, would likely be more effective.
For
That's
example?
a tougher job. Well, Aaron just made some comments in that regard. Tax credits for investment, investment that is in Ontario. That's not necessarily calling for industrial planning. That is calling for geographic planning, perhaps, but it's getting the signals right. But my point on investment is that investment is drawn by growth. It's a virtuous cycle. Investment drives growth, but then growth draws out further investment. And so the whole story ultimately returns to where does one find the economic growth in our system? And as I said at the outset, that is shifting more to external forces such as the U.S.'s economy and their demand for our exports. And it will shift a little bit away from our reliance only on Canadian consumer spending as we try to deleverage that part of our system, and some reduction in government spending.
We've got about a minute left here, Avery, and let me give it to you to speak to this. We seem to be okay at making free trade agreements with the United States, with Mexico, with Europe, with lots of other countries around the world, but sadly not among provinces. If part of a plan to create 1 million jobs over 8 years depends on free trade agreements among provinces, which so far in almost 150 years of Confederation have eluded us, how likely is any of this to happen?
Well, the barriers across provinces are not nearly as big as the barriers we address through these international agreements. There are specific sectors where we've got different jurisdictions ruling over, for example, my own sector, the financial services sector. Right. It doesn't really make any sense economically. We haven't been able to reach a deal to have one regulator. We do have barriers, for example, certainly in things like alcohol and so on, where governments are involved in the retailing. So it's not easy to address them, but I would say that they are probably not nearly as significant as the barriers we had addressed in some of those other across borders internationally.
Gotcha. Gentlemen, I thank you for your time tonight talking about what 2014 may look like. with a change of decimal point of 0.2% or so. Avery Schenfeld from CIBC, Donald Breen from the Rotman School of Management at U of T, Aaron Weir from the United Steelworkers Union. Thanks, everybody, very much.
Support Ontario's public television. Donate at tvo.org.